9:01 a.m. Your paycheck finally lands. By 9:12, it's already gone in little bites. Rent, a credit card minimum, a car payment, an auto bill you forgot you signed up for. The number drops so fast, it barely feels like you ever had it. That stuck feeling isn't a personal flaw. It's what happens when the rules around you move faster than your income. Right now, the typical bank credit card rate is about 21%. One rough month doesn't just set you back, it makes your next month more expensive. And when the Federal Reserve keeps its benchmark rate in a 3.50% to 3.75% range, borrowing gets pricier across the board, even if you're doing everything right. Meanwhile, prices are still climbing. Inflation ran 2.7% over the 12 months ending December 2025. So when someone says, just build multiple income streams, it can land like blame. This video isn't about getting rich. It's about seeing the system, so you can stop guessing and start feeling a little more control. Hey, I'm Dax. Welcome to Dax Invests. If you're 18, 21, 24, and money feels like constant background noise, I get it. Not because you don't want it enough, but because a lot of your choices live inside rules you didn't write. Most advice online treats your life like a spreadsheet. Add an income stream. Stack your hustle. But if your base costs keep rising, a new stream can turn into a second job without changing the math that's squeezing you. So we're going to slow down and look at the math first. 3 numbers quietly shape your week. The Fed's rate, a target range of 3.50% to 3.75%, which ripples into borrowing costs. Inflation, 2.7% over the past year, which raises the floor on everything. And credit card APRs hovering around 21%, which punish one rough month. When I say systems, I mean boring, repeatable setups. How bills get paid, how debt gets handled, how savings happen automatically, and how you build shock absorbers. Not to get rich overnight, just to stop living one surprise away from panic. The first warning sign isn't a recession headline. It's smaller than that. Your rent renewal comes with a market adjustment. The used car lot tells you the same car now means a higher monthly payment. Your credit card minimum creeps up even though you didn't really live it up. Those aren't random, they're gauges. When the Fed holds the policy rate in a 3.50% to 3.75% range, most borrowing costs lean in that direction. When inflation runs 2.7% over the year, the floor rises under everything you buy. And when the average credit card rate is about 20.97%, carrying a balance turns time itself into a fee. Housing is the loudest gauge. The Case-Shiller National Home Price Index is still near record levels, which helps explain why saving for a down payment can feel like chasing a moving bus. This is why I keep saying, don't just add income, build liquidity, cash you can reach fast, so one surprise doesn't get to decide your whole year. Here's the quiet truth. A second job doesn't fix a system that charges you for being human. If your rent climbs, your loan rate resets, and your groceries creep up every month, more income can feel like pouring water into a bucket with holes. When I say systems, I mean repeatable rules that protect you on your worst week, not your best week. Systems decide whether a surprise bill becomes a small inconvenience or the start of a spiral. They decide whether your money moves first toward interest and fees or toward your future. Multiple income streams can help, sure, but without a system, they usually do one thing. They raise your stress while your baseline stays fragile. A system is autopay, buffers, and clear priorities, so your life doesn't fall apart because your boss schedules you 2 hours short. Next, we'll track the levers: interest rates, inflation, housing prices, exchange rates, CDS, and liquidity. Then bring it back to your real life: student loans, credit cards, car payments, and rent. Because getting rich is a maybe. Staying stable is the goal. Interest rates are the price of borrowing. That's it. But in your life, that price shows up as stress. The Fed sets a target range for the federal funds rate, right now 3.50% to 3.75%, and everything else takes cues from it: credit cards, auto loans, even some student loan rates. And the numbers are heavy. The average credit card APR at commercial banks was 20.97% in November 2025. New car loans aren't cheap either. The average rate for a 72-month new auto loan was 7.52% in November 2025. So when a month goes sideways, debt doesn't just wait, it compounds. Minimum payments keep you current, but they can also keep you trapped, because the system's default setting is that interest gets paid before you get breathing room. If you've ever felt your stomach drop opening a statement, that's not you being bad with money. That's you noticing the meter is running. This is why more income isn't the first fix. The first fix is designing your cash flow so high-rate debt can't quietly keep rewiring your future. Inflation is the slow squeeze, not a dramatic crash, just the feeling that the same life costs more. In the 12 months ending December 2025, the Consumer Price Index rose 2.7%. That sounds normal until you remember, beginners don't start with extra. If you're 20 to 24, median weekly earnings for full-time workers were about $796 in Q3 2025. After taxes, benefits, and rent, a few percent matters. And inflation doesn't hit evenly. Housing and transportation can move your whole budget. Even when prices stop accelerating, they don't rewind. The new price becomes the baseline you have to live on. This is why people feel crazy when headlines say things are improving. Your brain is tracking the level, not the rate. A 2.7% climb still means the floor rose again, while your paycheck might be barely catching up. If you're paycheck to paycheck, inflation is basically a tax on flexibility. So the system question becomes, how do we build room in a world where the floor keeps inching higher? Housing is where the system gets loud, because shelter isn't optional. The Case-Shiller National Home Price Index was 328.442 in October 2025. Near record territory. Translation? The entry ticket to ownership stayed high even as the market cooled, and mortgage rates, while down from the peak, were still around 6.2% in early January 2026. So you're stuck with a choice that doesn't feel like a choice. Rent and watch renewals creep up, or buy and take on a payment that can eat your flexibility. For a lot of young adults, rent is the only move. But it can also make saving feel impossible because the finish line keeps walking. This is where I want you to hear something clearly. The struggle isn't imaginary. Roommates, family, smaller spaces, those aren't failures, they're survival math. When a basic need becomes a financial product, the monthly bill becomes a lever. A money system doesn't magically make housing affordable. It just stops housing from turning every other goal into collateral. Exchange rates sound like global stuff, but they leak into your life quietly. The dollar's value affects what the US pays for things the world makes, and what the world pays for what we sell. One common gauge is the trade-weighted US dollar index, a weighted average of the dollar against a broad set of trading partners. When that index falls, imports tend to cost more in dollars. Reuters reported the trade-weighted dollar depreciated about 7.2% in 2025, a move that helped push import prices. Now, that doesn't mean your phone instantly gets expensive, but it's the background pressure behind price tags, especially for goods with supply chains that cross borders. And globally, exchange rates can become a crisis trigger. If a country or a company borrows in US dollars, then its own currency drops. The debt effectively grows. Same loan, bigger burden. That's the first pattern we'll keep noticing. When currencies move, systems strain, because promises were made in a different unit. Liquidity is a fancy word for a simple question. Can you turn this into cash quickly without losing a chunk of it? In normal times, liquidity feels invisible. Swipe your card, pay your bills, banks lend, markets trade. But in stress, liquidity is the first thing that disappears because everyone wants cash at the same time. Behind the scenes, huge parts of the financial system run on short-term borrowing called repo. The Financial Times reported U.S. repo exposures averaged about $12.6 trillion per day in Q3 2025. That's not trivia, it's the plumbing. When that plumbing clogs, lending tightens, businesses pull back, hiring slows. And for you, it shows up as, my limit got cut, my rate went up, or I can't refinance. This is why the Fed runs tools like the discount window to provide ready access to funding and support bank liquidity in stress. At the personal level, liquidity is your buffer. It's the difference between a setback and a cascade. Now, CDS. Credit default swaps. They sound like Wall Street noise, but they're basically insurance prices on debt. A CDS is a contract where one side pays a premium and the other side pays out if a borrower defaults. The premium, called the spread, moves up when investors get nervous. So CDS spreads can work like a stress thermometer. They often twitch before the average person ever sees a headline. Even the US has a CDS price. In November 2025, Reuters noted 5-year US government CDS spreads around 37 basis points. That's not panic, but the point is, the market still prices default risk, even for the safest borrower in the room. Why does this matter to you? Because the same logic shows up in your own life. When your credit score drops, your spread widens. Your loans cost more. Your options shrink. Systems don't only live in textbooks, they live in pricing. And pricing is how the system tells you what it thinks you're worth under pressure. Let's zoom out to a real shock. The 1997 Asian financial crisis. Thailand had been trying to defend its currency, burning through foreign exchange reserves. Then, on July 2, 1997, it devalued. When the currency dropped, debts tied to the US dollar got harder to repay. Investors rushed for the exit. Banks tightened credit. And suddenly, a problem that looked like currency stuff became layoffs, bankruptcies, and a frozen economy. Here's the system lesson. Crises don't usually start as one giant explosion. They start as a mismatch. Too much short-term borrowing, not enough reserves. Assets priced like the good times will last forever. Then the crowd changes its mind, and liquidity disappears. If you've ever watched your own finances do a tiny version of that, your paycheck comes in, then a bill hits, then your account feels like it's shrinking faster than you can refill it. You understand the shape of it. Different scale, same pattern. Leverage, fear, and the search for cash. Argentina is another case where the word liquidity mattered. For years, Argentina ran a hard currency peg. 1 peso meant 1 US dollar. It felt stable until it didn't. When investors doubted the country could keep the promise, money fled. The government needed cash to keep paying and defending the peg, but cash was exactly what was disappearing. The IMF later described how, in early 2001, support was augmented under the assumption the situation was largely a liquidity crisis. That phrase is important. A liquidity crisis means you might be fine long-term, but you can't make next week's payments. A solvency crisis means, even long-term, the math doesn't work. When markets decide you're in the second category, the cost of borrowing explodes. The currency strains, and ordinary people pay the price through lost savings power, higher prices, and limited access to cash. The takeaway isn't fear Argentina. It's to notice how fast confidence can change the cost of money. Greece shows what happens when a country can't print the currency it owes in. Inside the euro, Greece borrowed in a currency controlled by a shared central bank. When its debt and deficits became a headline, markets demanded higher yields, and the fear showed up in CDS. A European Parliament paper noted that in early May, Greek sovereign CDS spreads rose to nearly 1,000 basis points. That number is just a price tag on worry, but it carried consequences: tighter financing, harsher terms, political pressure, and a long stretch of austerity. For regular people, sovereign risk turned into unemployment, cuts, and a feeling that the future had been negotiated somewhere else. Again, the pattern isn't about one country being bad. It's about systems. If your funding depends on others believing you can pay, then confidence becomes a resource, like cash. And for you, personally, the closest parallel is credit access. When lenders lose confidence, the terms harden fast, sometimes overnight. Turkey is a modern reminder that currencies don't just move. They change lives. When inflation runs hot, people lose trust in money as a storage tool. So they rush into dollars, gold, anything that feels steadier. That rush pressures the currency, which can push prices up again, because imported goods become more expensive. To fight that, central banks often raise rates hard. Reuters reported Turkey still had inflation around 31% and interest rates around 38% as 2026 began. And when the lira kept sliding in earlier years, Turkey tried unusual protections, like FX-protected deposits that compensated savers for currency losses. Reuters said that program, introduced in 2021, was ended in August 2025. Notice what's happening. People aren't panicking because they're emotional. They're reacting to incentives. If your money melts, you move it. That's the system lens. Stability isn't a vibe. It's policy, credibility, and the ability to provide liquidity when everyone needs it at once. Venezuela is the extreme edge of the same story. When trust in money breaks, money stops working. Venezuela entered hyperinflation in the mid-2010s. A record compiled from Venezuela's central bank estimates later put inflation at 130,060% in 2018 and 9,586% in 2019. In that kind of environment, prices can change faster than paychecks, and cash becomes something you spend immediately because holding it is like watching ice melt. That's not just an economics term. It's the collapse of planning. Savings don't save. Long-term contracts don't mean much. The whole financial system becomes short-term survival. The IMF's country profile database tracks Venezuela's macro picture, GDP, growth, and more, because these aren't isolated problems. They're measurable system outcomes. For us in the US, this isn't a prediction. It's a boundary marker. It shows what happens when inflation and currency stability are lost completely. The future gets harder to imagine. And that's why systems matter. They're what make tomorrow feel real. Okay, back home. Because your life is not a sovereign bond chart. The New York Fed reported total household debt at about $18.585 trillion in Q3 2025. And after student loan reporting resumed, delinquencies showed up fast. In Q3 2025, 9.4% of aggregate student debt was reported as 90-plus days delinquent. Outstanding student loan balances were around $1.64 trillion in 2025 Q2. That's the backdrop for the "I'm doing everything right but still drowning" feeling. Because for a lot of young adults, the stack is predictable. Student loans, then a car payment, because transit isn't built for everyone, then a credit card balance that fills the gap between paychecks, then rent that keeps renewing higher than your raise. Paycheck to paycheck isn't a personality. It's what happens when fixed costs meet high rates and low slack. So the question becomes, what can you control without pretending the system isn't real? When crises hit, governments and central banks don't save everyone. They try to stop the plumbing from breaking. The Fed can lower interest rates. It can also lend against good collateral through the discount window to support bank liquidity so credit doesn't freeze. In 2008, the Fed created emergency facilities under Section 13.3 that were mainly about short-term liquidity, keeping cash moving when markets seized up. And when rates are already low, central banks may use quantitative easing, buying securities to push down longer-term rates and add liquidity. On the government side, there are fiscal tools like unemployment support and direct aid. And there's a quiet backstop most people forget: FDIC deposit insurance, up to $250,000 per depositor, per insured bank, per ownership category. None of this is magic. It's stabilization. Time is what keeps a slowdown from turning into a panic. So what does a system look like when you're young and still feel stuck? It starts with liquidity on purpose. Not 6 months of expenses overnight, just a buffer that keeps one surprise from forcing a credit card swipe. Liquidity is safety because it buys you time to think. Then, you control the order of your money. Essentials first, minimums to stay current. And after that, the stuff with the highest interest and the most anxiety attached, often credit cards. The goal isn't perfection. It's stopping the meter from running in the background. For student loans, the system is knowing your plan and what your payment actually does. For car payments, it's being cautious with long terms that lower the monthly but raise the total cost. For rent versus owning, it's treating stability like an asset, even if renting is the right move for now. And if this calm, no-hype money clarity helps, You can subscribe to Dax Invests and keep a steady guide in your corner. Because the point isn't to hustle harder, it's to build a life that can take a hit and still stand. If you remember one thing, let it be this. Money stress isn't only about how much you earn. It's about how exposed you are. Interest rates decide how expensive mistakes become. Inflation decides how fast your baseline rises. Housing prices decide how much of your life gets locked into shelter. Exchange rates decide how global shocks seep into local prices. CDS and liquidity decide how fast fear can spread through the system. You don't control those levers, but you can build a personal system that doesn't collapse when they move. A buffer, a plan for debt, fewer fixed commitments you can't unwind, and a default path for your money that works even when you're tired. Multiple income streams are fine. They can be helpful, but they're not a foundation. Systems are a foundation, because systems keep working on the days you don't. So we're not chasing rich, we're building control. Not perfect control, just enough to breathe. Enough to make choices that belong to you, not to the next interest charge or the next headline.